Hello ladies and gentlemen. In this video I'm going to look at balancing general ledger accounts and drawing up a trial balance. If a trial balance occurs during the financial year, during the current period, it is known, you can call it a pre-adjusted trial balance because no adjustments have taken place. Adjustments only occur at the end of the financial year. So in this video, I'm going to give you a lesson on how to balance general ledger accounts. There's capital and drawings, and extract from the general ledger of Calibre Education. Once we've finished the general ledger and I've shown you how to balance a few accounts, we will draw up a trial balance, which is a pre-adjusted trial balance. If I can show you where we are on the monthly accounting cycle, what we would have done, we would have transacted, all these transactions were recorded on source documents. The journals were drawn up, all the 8 journals which you've seen in previous videos, and now this information has been taken to the general ledger, and we're going to balance a few general ledger accounts just to show you how. Then we're going to take the balances to a trial balance or a pre-adjusted trial balance. This occurs every month of the business, and after 12 months adjustments are done at year end. But in this video, all I'm going to have a look at is balancing general ledger accounts, taking the balances of all the general ledger accounts and drawing up a pre-adjusted trial balance. So that's the plan for this lesson. Well, let's go. Just to illustrate what I've just mentioned, Calibre Education had all these transactions for February. Remember, when we drew up the journals, we entered the second month of trading, and all these transactions occurred. This is only until the 18th of February, but I've just included these to illustrate that monthly cycle. Transactions take place. All these transactions are journalized, and all the transactions are recorded on source documents. There's an example of a tax invoice. We've been through this, but just to get you to general ledger accounts, I'm just going through the process, the cycle. So all the transactions have been recorded on source documents. There's a tax invoice, and everything on here is what's required for revenue services. There's an example of a credit note. When an account is credited, we got a credit from the computer store here. All transactions are documented. And on a credit note, remember, you need a reason for the credit. There's a cash tax invoice. There's a bank deposit slip, a journal voucher. Now all these source documents are used to record the transactions in the journals. And if we have a look here, we did the cash book receipts. Hopefully you've seen the videos on the journals. So we've gone transactions, source documents, journals, and at the end of the month, the totals of the columns were posted to the general ledger accounts. That was demonstrated in all the videos on the different journals. We applied the rules when we made the postings. So let's take, for example, sales. Sales is income. That amount there was posted to the general ledger, and the rule says an increase in income, the account must get credited. So this is revision of what you've done already. So the sales account was credited because the rules say an increase in income results in an account in the general ledger being credited. So all the information from the journals was posted to the general ledger. If it had its own column, it would be at the end of the month. If it appeared under sundry, it would be recorded in the general ledger on the day the transaction took place. For example, the 12th. There's a cash payments journal. All these accounts were either credited or debited in the general ledger. These as well, according to the accounting rules. There's a petty cash journal. According to the rules, those accounts in the general ledger were either debited or credited. Debtor's journal. Debtor's allowance journal. Creditor's journal. Creditor's allowance journal. This is revision. And the general journal. Now from all these journals, the information was taken to the general ledger on a monthly basis. And now we're going to have a look at steps to balance general ledger accounts. Step 1. Record the opening balance. I'm going to demonstrate how to balance a few general ledger accounts in a moment. But step 1, record the opening balance. Step 2. After all the transactions have been entered from those journals that I just showed you, you need to check, is the debit side or the credit side bigger? Step 3. On the last day of the month, add to the smaller side, either the debit or the credit, the difference between the two sides. This amount that you add to the smaller side is known as the balance carried down. Don't worry, I'm going to show you how to balance a few accounts. At the moment, I'm just going through some rules I made up. Step 4. Total both the debit and the credit side. Place the totals on the same line. So after you've added the difference, you add up both sides, the debit and the credit, like that, and the two sides will balance, balancing the accounts. But that's not the last step. On the first day of the next month, on the opposite side to the carried down amount, you're going to have the balance brought down. So when you start the transactions or the accounts for the next month, you will have an opening balance from the previous month. So these are the 5 steps we're going to use when we record general ledger accounts. Step 1. I'm going to use this account here, the loan. Calibu Education took out a loan with the bank. Now step 1, it says record the opening balance. So I go and look for the opening balance of loan with the bank. and there it says 130,000. Now that was at the end of January, but the point here is you need to go to the previous month's trial balance and you check what the final balance was, because at the end of January the loan had a balance, a credit balance of 130,000. Remember, loan is a liability. When we took it out, there was an increase in liability. Increase in liability, the rule says you must credit. So as a result of the transaction, taking out the loan account ended up with a balance of 130,000. So step one, record the opening balance. And it says it's in the credit column. So the opening balance will be on the credit side. We're doing the transactions for February. It's 2024. February the 1st, the balance brought down is 130,000. So step one, record the opening balance. Always look for the opening balance. If it's the first month of trading, there might not be an opening balance. Transactions still need to happen. But this is the second month of trading, and Calibre Education had taken out a loan, and the opening balance on the 1st of February is 130,000. Step number 2. After all the transactions have been entered, check which side is bigger. So we've entered the opening balance. Now we need to go through the journals and we need to enter the other transactions which relate to the loan, which occurred during February. And this year I took an extract from the cash payments journal of Calibre Education for February. It says there that 2,000 Rand was paid back on the loan. Now if we pay back a loan, the amount of money that we owe, at this stage 130,000, is going to get smaller because we're paying off the loan. The liability is going to decrease. A decrease in liabilities, the rule says, go and debit the account. When did this transaction take place? On the 3rd. It appears under sundry, so we need to put the transaction into the general ledger on the day the transaction took place. Where did we get this information? From the bank statement. Decrease in liabilities, debit the account. Now what they've done here in this example, they've gone and put the 29th. This could have been put down on the 3rd because that's when the transaction took place and it appeared under sundry. So let's say 2024, February the 3rd, the name of the contra account is bank. Where did we get the information? From the cash payments journal. How much did our liability decrease by? The amount that was paid, 2,000 Rand. So that's one transaction. It says after all the transactions have been entered. So let's check if there are any more. Yes, there's another transaction. What happened was the bank doesn't give us the loan for free. They charged us interest on the loan of 1,500. This here is an extract, a screenshot of the general journal. Now the interest on the loan is going to cause the loan to increase. So when the loan increases, we owe more money. There's an increase in liabilities. On the 3rd, the contra account is interest on loan, the other account affected by the transaction. Where did we get this information from? the general journal. What was the amount? 1,500. This is quite interesting. We paid back 2,000. We were charged interest of 1,500. So after 1 month, if you do the maths in your head, we paid 2,000, but the loan only went down by 500. That's how a loan works. Quite interesting. You keep paying it off for a long time. A loan. And step 3 says here, on the last day of the month, add to the smaller side the difference between the two sides. So now we have the opening balance, we have the two transactions for the month that relate to the loan. Now what we need to do is we need to add to the smaller side the balancing amount. So if we say 130,000 plus 1,500, I can see straight away that the credit side is much bigger than the debit side, because there's the full amount of the loan, 130,000. I add the interest and I subtract what we paid back. Step 3 says add to the smaller side, which is the debit side, the balancing amount, and it is called the balance carried down. And when is this done? On the last day of the month. So we see a balance carried down, and if I took the debit total minus the 2,000 credit, we will get 129,500. So step 3 says add to the smaller side on the last day of the month the balance carried down. So we've done step 3. Step 4, total both the debit and the credit sides. Place the total on the same line. So it says total up the debit side and total up the credit side. And what do we get? On both sides, 131,500 and 131,500. Now this here, balancing general ledger accounts, is a technique that was introduced, and this is how it should be done if you do accounting manually. This is just the way it is done, right? Balancing general ledger accounts. So step 4, we total both sides, and this is most probably where the word balancing comes from. The two sides are equal because we've added to the smaller side the balance carried down. And step 5 says on the opposite side of the balance carried down, that's the balance carried down, on the opposite side of the balance carried down, on the first day of the next month, you say balance brought down. And there it is. March the 1st, the balance brought down is 129,500. Now what this means is when March starts, we owe the bank 129,500 Rand after the transactions that took place in February. So we got here balance brought down. We put in the two transactions for February. We added up the credit side. We subtracted the debit side. We added to the smaller side the balance carried down. We totaled both sides. Then on the opposite side of the carried down, the 1st of March in this case, we have what we call the balance brought down, 129,500. I just want to point this out. The balancing amount is known as the balance carried down. It happens on the last day of the month, and the balance brought down happens on the first day of the next month, and it's called brought down. Brought down on the first day of the month, carried down on the last day of the month. You can see we started this account here on the 1st of February, and it was the balance brought down. So on the first, brought down, on the last day of the month, carried down. And that there is a neat loan account that has been balanced with the opening balance, the two transactions for the month, one on the debit side, one on the credit side, the balance carried down number and the totals, and on March the 1st the balance brought down is 129,500. That is the loan account balanced, and your first general ledger account balanced. Now we're going to move on to completing the whole general ledger of Calibre Education for the month of February. I just did the loan account as an example of how to balance a ledger account. Now before we move on, remember I showed you in that loan account where the opening balance, where we got the opening balance for the loan from. It was from the previous month's trial balance. So all the ledger accounts that we're going to complete, the first thing you do when you do a general ledger account is you look for the opening balances. Now I'm going to start with capital. So this here is the capital balance, what the owner has put into the business as at the 31st of January 2004. Remember, we're moving on to the transactions for February, and this here, a trial balance is divided into two sections: a statement of financial position, and in here you have owner's accounts is equal to assets plus liabilities. That there is the same as a balance sheet, or the modern name, a statement of financial position. So in a trial balance, you're going to have asset accounts, owner's equity accounts, and liability accounts in the statement of financial position section. These accounts are all given folio references. This year it says B1, B2, B3, B4, etc. That stands for balance sheet accounts, but remember, it is now known as a statement of financial position. So there's, let's call it a balance sheet section, and there is a nominal accounts section, and in the nominal accounts section you can see for yourself, what do you have? Income and expenses. So just for interest's sake, at the end of January, if I added up all my income and I subtracted all my expenses, you could determine the profit or loss as at the 31st of January 2024. So we have a selfie of the business position on the 31st of January. But we're concerned here in this video, that was a little bit extra. I'm concerned about how to balance general ledger accounts and how to draw up a pre-adjusted trial balance. So let's move on. Remember, this information here on this page, it gives me the opening balances for each general ledger account. Let's now use the steps to balance the capital account. Step 1, record the opening balance. Where does the opening balance, where do we get it from? The previous month's trial balance. So here is a screenshot of the previous month's trial balance. The opening balance for capital was 90,000. That balance is on the credit side. So on the 1st of February, the balance brought down from January's trial balance is 90,000. Remember, on the 1st, we write brought down. B/D stands for brought down. Step 2. After all the transactions have been entered, check which side is bigger, the debit side or the credit side. So let's enter all the transactions. During February, this is a screenshot of the cash book receipts. Richard deposited another 20,000 into the business. The rule says an increase in capital down at the bottom of the page. The account capital must be credited with the amount on the day the transaction took place. 20,000 because it appears under sundry. So this happened on the 1st. I don't have to write the 1st again. The contra account is bank. Where do we get the information? From the cash receipts journal, cash book receipts or cash receipts journal. The amount was 20,000. Then also at the bottom of the page, there's a screenshot from the general journal. Richard contributed a vehicle to the business, so the capital contribution was 100,000. So that information is taken to the capital account. Capital was credited because it was an increase in capital. Where did the information come from? The general journal. The contra accounts were vehicles and input VAT. That was explained in the general journal, as were all the transactions in the videos on the journals. The amount was 100,000. Now we've done step 2. Step 3 says on the last day of the month, add to the smaller side the difference between the two sides. Remember, known as the balance carried down. Now this is quite easy because there are only transactions in this capital account on the credit side. And if I go and add this up, we add it up, we check which side is bigger. Obviously the credit side is bigger because there's nothing on the debit side. Now it says I need to add to the smaller side the difference between the two sides. And that amount is 210,000. On the last day of the month, how many days in February? 29. And it's the balance carried down. There are 29 days in February because 2024 is a leap year. So now I've got the balance carried down, which was the difference between the credit side and the debit side. The debit side had nothing in, and the credit side had 210,000. Step 4, total up both sides on the same line. So if we total up both sides, do you see I've skipped a line and I've skipped a line? The totals are on the same line. That's just the way it's done because it's much easier on the eye if the totals are on the same line. Step 5, on the opposite side of carried down, On the first day of the next month, bring the balance down. It's the balance brought down, and it is the same amount as carried down. And there it is. March the 1st, the balance brought down is 210,000. And if you want to see that done neatly, we've got the general ledger of Calibre Education. We're balancing the capital account. Step 1, get the opening balance. Step 2, enter the transactions for the month. Step 3, get the balance carried down. Step 4, total both sides. It will be the same. Step 5, on the first day of the next month, the balance brought down on the opposite side is 210,000. Now, when March starts, there is the opening balance for March, and you might have a transaction and balance it again. The general ledger accounts are ongoing. You just balance the accounts at the end of each month in order to draw up a trial balance. So that there is balancing the capital account. It only had entries on the credit side, nothing on the debit side. So the carried down was the total of the credit side, 210,000. But there we go. Now we've balanced the loan account and capital. Let's move on. So I'm just taking you back to the trial balance, 31st of January 2024. The next account is drawings. So what is the opening balance for drawings? There's the drawings account. It's the second balance sheet account in the general ledger. Drawings, an increase in drawings, the account will get debited. Let's see, there was an opening balance. I showed you that already. The opening balance was 958. It's a debit balance because the increase in drawings was originally debited according to the rules. There's the opening balance on the 1st of February, 958. Now drawings take place for the month, and I go and take the information from the journals and I put it into the drawings account. Here we go. I just taken an extract from the general journal. Drawings was debited with 2285 and 72 cents. There it is. I'm not too concerned what the transaction was at the moment, but the owner would have taken stock for his or her personal use. I can see it came from the general journal, and the contra account is trading inventory. The transaction took place on the 13th. Then there's also drawings, and this here could have been from the petty cash journal. Let's see. Yes. So the owner took 200 for his personal use. Contra account is petty cash, came from the petty cash journal. Now in this drawings account, I'm not putting the steps up here because you're getting the idea. So the drawings account has entries on the debit side. The rule says check which, now step number 3, which side is bigger. I can see the debit side is bigger because there's nothing in the credit side. So you're going to subtract the two sides. Oh, I see there's another drawings amount from the petty cash, 50 Rand. Maybe the owner bought some stationery for 50 Rand. So we add up the debit side and we subtract the credit side. And to make the two sides equal on the last day of the month, we have the balance carried down of 3493 and 72 cents. Total up both sides, 3493 and 72. And on the opposite side, on the first day of the next month, we're going to have the balance brought down. Now what that account is telling me is that the owner has withdrawn cash and stock to the value of 3493.72 as at the start of March, the 1st of March, or as at the 29th of February. If we draw up a trial balance, a pre-adjusted trial balance, the balance for drawings will be 3493. Now we've balanced three accounts, three balance sheet accounts: the loan, capital, and drawings. This is the drawings account, neat version of the drawings account. We know that drawings is its own category. There was an increase in drawings in the month of February. Cash and stock was taken by the owner, and if we balance this account, March the 1st, the amount of drawings, the value of the drawings that the owner had taken, consisting of stock and petty cash, was 3,493 and 72. Remember, the drawings is going to make the owner's equity less, what the owner is worth in the books less. But remember, we're just concentrating on balancing ledger accounts. So there's the balance that will be taken to the pre-adjusted trial balance, or just the trial balance. So there's the drawings account. We've gone through the capital account, the drawings account, and I'm quickly just going to run through the loan account again, although I have done it, but let's do it quickly. So we have in the loan account a balance brought down. Then there were transactions which relate to the loan. We got the opening balance from the trial balance of the previous month. We got the interest on the loan from the general journal, 1,500. We made a payment to pay off the loan, 2,000. So now we got the opening balance, the two transactions that relate to the loan. One was a decrease in liability, so it would have been debited, the paying back of the loan. The interest on the loan increased what we owed the bank. It was an increase in liability, so the rule says it got credited. Now we check which side is bigger. The credit side is bigger than the debit side by the balance carried down, which is 129,500, which is an amount which makes the two sides equal. So on each side, there's now, with the carried down being added, a balance of 131,500. But those are just the totals. Then on the first day of the next month, we have on the opposite side to carry down the balance brought down. And that is the figure we're interested in, because after all the transactions that have taken place with regard to the loan for the month of February, the balance of the loan is 129,500. That is what Calibu Education owes the bank. And once again, written out neatly, there is the loan account of Calibu Education. We have balanced it. And we move on. Remember, in a pre-adjusted trial balance or a trial balance or a general ledger, there's normally a order that the accounts occur. First the owner's accounts, capital and drawings. Then we're looking at, in this case here, long-term loans, non-current liabilities. So we had the loan. Now we've got assets, and the assets are in order of liquidity. What that means is furthest away from cash to cash. That's the order of the general ledger accounts. So yeah, we got vehicles. I've got all the information in here already. We started with the balance brought down. Remember, vehicles is an asset. Assets have debit balances. There's the balance. Where was this amount obtained from? The previous month's trial balance. I've gone through that already. Then there was a transaction that took place. The owner contributed a vehicle. That is the amount less VAT. Now we need to balance this account. So these were the two entries on the debit side. Subtract nothing gives us the balance carried down. And we total up both sides. And then on the opposite side, we got the balance brought down on the first day of the next month. Remember, last day of the month it was called, it was named carried down. The first day of the month it was named brought down. At the 1st of March 2024, our vehicles at cost price were valued at $152,522.02. Equipment. I'm not going to go through the whole account, but basically equipment was bought for cash and on credit, and then that is a correction of error. The equipment account was debited instead of advertising, and some equipment was returned. But this I've done in the journal videos. My objective here is to look at balancing general ledger accounts. So we add up the debit side. We subtract the credit side. We make the two sides equal by adding to the smaller side the balance carried down. We total up both sides, and on the opposite side we got the balance brought down. On the 1st of March, we have equipment at historical cost price, at the historical cost price, 17,274.34. Equipment is an asset. Trading inventory is an asset. Now this is quite an important account. If you did have to prepare for a test or exam, know all the entries that go into the trading inventory account, your stock account. There's the opening balance. There were all these there's sales, cash sales, and credit sales. Creditors allowance journal. Stock was returned. Owner withdrew stock. And creditors control. I'm not 100% sure what that transaction was there, but it resulted in a decrease in the value of stock, and it was journalized. And if we wanted to know more about that transaction, we'd need to go back to the journal voucher, the source document, or general journal number 2. But for balancing this account here, you need to add up the debit side, and you need to make the two sides equal by adding to the smaller side, the credit side, the difference between the debit side and the credit side entries. There's the balance carried down, and on the first day of the next month we have the balance brought down. So our stock, according to our books, is worth 37,398 and 96 cents. Debtors control. It's an asset. We have credit sales. We paid for the transport of stock to a debtor on the debtor's behalf. We paid out of the petty cash and charged to the debtor's account. Now, in order to balance this account, we add up the debit side and we add up the credit side. The difference between the two is 18 cents. Interesting. And the balance brought down on the debit side. We have debtors on our books to the value of 18 cents. What I would do, and more about that later, is at the end of the month you do a debtors reconciliation. So you're going to take the balance of the control account and compare it to the list of debtors which you get from the debtors ledger. But remember, this video is all about balancing general ledger accounts and drawing up a trial balance at the end of the month. So there's debtors control balanced. Input VAT, there it is, balanced, all the entries. Balance carried down, balance brought down. There's the bank account. Got a balance brought down, total receipts, total payments. What should be in our bank account? 150,622 and 97 cents. What we need to do, and it will come up in a video after this one, is a bank reconciliation, because we get a statement from the bank that might have 150,000. So in our books there's a difference to what's on the bank statement. We need to go and reconcile. That will be done in a future lesson. Petty cash, easy. There we got the balance for petty cash. Output VAT, which is a liability, what is owed to SARS, 31,961 and 62. Remember, if you check the VAT videos, don't go and pay that amount. When you do a VAT return, you say output VAT minus input VAT, and that amount gets paid over to revenue services. But you should have completed the VAT videos at this point. Creditors control. What do we owe our creditors? 600 coming up as well. So creditors reconciliation. We get a statement from a supplier and we need to check before we pay the supplier if their statement reconciles with the balance we owe according to our books to a creditor. The control account is a summary of all the individual creditors or suppliers, accounts payable. Now we get on to the N accounts, nominal accounts, income and expense accounts. We render a service and we also sell digital products. And there you can see the sales account has been balanced. We have the credit side and the debit side, the difference between the two sides, and that results in the balance brought down on the first day of the next month, 159,972 and 9 cents. That's my sales for the month. Current income is interesting because the balance brought down was 27947 and 6 cents, and you could actually, was only one entry there, total that up, and that would be fine. 27,947 and 6 cents. But I will show you more like that in a moment. Cost of sales. I'm going to go through the cost of sales account. So let's work through this cost of sales account. Cost of sales is an expense, just to refresh your memory. An increased expense would be debited, which would result in an opening balance. Remember, we get the cost of sales or any general ledger account opening balance from the previous month's trial balance, and cost of sales had a debit opening balance of 59,129. So we put it in on the first day of the month. There it is. Step 1 of balancing general ledger accounts. Step 2, put in the other entries which relate to cost of sales for the month of February. And this here is an extract or a screenshot from the cost of sales column in the cash receipts journal, and the total will get posted to cost of sales, and cost of sales will get debited as it is an increase in expense, and therefore on the debit side of cost of sales we got 29,968 and 94. That came from the cash book receipts journal, the cash receipts journal. Then from the debtors journal, there's the column, the cost of sales column. From the debtors journal, there was an amount of 25,757 and 76 cents posted from the debtors journal on the last day of the month. Then there was a cost of sales amount that came from the debtors allowance journal, where debtors returned goods to us. There's the amount on the credit side. Next step, there it is. We needed to add up the debit side, subtract the smaller side, the credit side, which gave us 113 and 467. Then we needed to add up both sides. And on the first day of March, on the opposite side to carry down, we needed the balance brought down. And that's how to balance the cost of sales account, which is an N account, a nominal account, when there are entries on both sides. In this case, there were entries on the debit side and the credit side. And this is what the completed cost of sales account looks like. There's the balance brought down on the debit side from the previous month's trial balance, the entries from the cash book receipts, the debtors journal, and the debtors allowance journal. We total up both sides by adding the balance carried down to the smaller side, which is the credit side, and on the opposite side of the carried down, on the first day of the next month, we have the balance brought down of cost of sales, and it's 113,467 and 53 cents. So of the sales we made, the cost of the sale was 113,467.53 to date until the 1st of March of the financial year. Because remember, our general ledger accounts are keeping a running balance for the current year. All these nominal accounts at year end will be closed off when we calculate the profit or loss for the financial year, but more about that a little bit later. I'm going to run through the rest of the general ledger accounts quite quickly, as I've showed you how to balance both balance sheet accounts and nominal accounts. But as I move forward, I'll point out a couple more things. Here we have some income accounts, interest on current account. Now, in the nominal accounts section, where we look at the income and expense accounts, we will have the balances brought down and those transactions which relate to the individual general ledger accounts, in this case the interest on current account. Now if there are entries only on one side, as in this account, interest on current account only has entries on the credit side, we can total the transactions. So 98 plus 173 is 271. There are only transactions on one side of the account. We can total it on the last day of the month. When we start the next month, we will have on the 1st of March total brought down, and we'll continue with the interest on current account. So if we look at the telephone account, there was a balance brought down from the previous month. There were only one telephone bill, which was paid from petty cash, and you can total it because there were two transactions on one side. Wages, the same, two entries on one side, on the debit side, get a total. So that's how it works. Rates and taxes, you can total. Insurance, you can total. Bank charges, you can total. Remember, all the time we are applying the accounting rules in order to determine whether an account is debited or credited. You need to categorize all these accounts correctly, as in a much earlier video when you started this course, and you apply your rules. Postage and stationery expense, staff expenses, it's an expense. Total, 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 and we applied the rules. Interest on loan, credit losses, which is another name for bad debts, it's an expense. We've written off debtors, accounts receivable. Sales returns, we've debited sales returns. Advertising, expense and expense. So those are all the general ledger accounts of Calibre Education until the end of February, the 29th of February. Now what we need to do is a trial balance. So once we've balanced all the ledger accounts at the end of February, we can draw up a trial balance and no adjustments have taken place. So this can be called a pre-adjusted trial balance. A pre-adjusted trial balance is actually the trial balance on the last month of the financial year, or the last day of the financial year before adjustments are made. But we will continue with adjustments at a future date. What I just want to show to you is a trial balance, a pre-adjusted trial balance, meaning before adjustments. So in this trial balance, we have a statement of financial position section where we record all the final balances of owners' accounts, assets, and liabilities. So we have the owners' accounts, liabilities, and assets in the statement of financial position section. All these accounts have folio references, in this case here B1, B2, B3, which stands for balance sheet accounts, and all these accounts either have a debit or credit balance according to the accounting rules that we followed. There are two sections in this trial balance. There's the statement of financial position section, and below that, let me just move on, is the nominal accounts section. And in the nominal accounts section, we have all our income and expense accounts. So we've got current income, sales, those are income accounts, and according to our rules they have credit balances, and all our expenses have debit balances. And as you can see, after we've listed all our general ledger accounts in this trial balance, the pre-adjusted trial balance, fortunately our pre-adjusted trial balance balanced, therefore our debits equal our credits. But remember, that doesn't mean that this trial balance is accurate. We may have debited incorrect accounts or credited incorrect accounts. We may have left out a transaction completely, but this is a good indication that things are accurate, the trial balance balances. And just quickly, you could calculate by saying the income less the expenses, the profit or loss for the year from the final balances in the pre-adjusted trial balance. But that wouldn't be quite accurate, as adjustments need to be made. But we will get on to adjustments in the future. So at the end of this video, we've learned how to balance general ledger accounts and take the final balances to a pre-adjusted trial balance. Thank you, ladies and gentlemen. We didn't hear too much from Caleb today, but I'm sure we will soon. There's Mommy and Caleb just relaxing after learning how to do and balance general ledger accounts and draw up a trial balance. Thanks, ladies and gentlemen. Keep it up. We only have a few more videos before you get to the end of the course.